We're live.
Hi, everyone. It's Nasia and Kristen from Les Maisons Partners. I hope you're doing well this evening. And we are beyond excited because we have one of our favorite lending partners here to talk a little bit about getting yourself together to own your dream home in 2021. And what is even more exciting is that we're going to be talking about a specific program that she has, and it's called the Mortgage Blueprint. I know it sounds exciting, it's kind of like a movie or something. So I'm going to let her talk a little bit more about it.
Well, thank you.
Go ahead.
Well, thank you. That's a hard act to follow, but first of all, I want to say Happy New Year to everyone. I'm so honored. I'm always pleased to partner up with you, lovely ladies, and like you said, we've all been passionate about helping people in our community get home ownership. One of the reasons we partnered together and I'm here tonight is because my team and I created a program called the Mortgage Blueprint. And what that is it's a program we started about 2 years ago. And for anyone that's serious about getting into a mortgage, we create a specialized plan to get you in that house, usually within 90 days. It could be a credit challenge. It could be an income challenge. It could be a debt to income ratio. And my nemesis last year in 2020 was the student loans. Whatever.
Yes.
We hear it all the time. Yes. Everyone has a different journey. So whatever your obstacle is, we'll help you. We sit with you one-on-one and we create a specialized mortgage blueprint, the blueprint to get you to home ownership.
And I think this is one of the things that we love so much because one of our focuses is education. And one of the things that we have told our clients, prospective clients all the time, is that you're never going to know where you are until you ask. And so one of the things that we like about our partners is they're not simply going to say, well, okay, you qualify for this much, or you don't qualify at all. They're going to actually sit down, and this is what the mortgage blueprint is about. Sit down and talk to you about what steps you need to take, even if you're not ready at that very moment. What are the steps that you need to take in order to get you where you need to be? And I think one of the biggest things that we encounter, and I mean, obviously, it could be anywhere, but we've got a couple of things. One is we encounter a lot of people who are not sure what their credit is, or they feel as if, well, my credit score might be low, but they're not sure what the bar is. So maybe if you could talk a little bit more about that particular challenge and how that fits in the mortgage blueprint.
Well, awesome. So yes, I agree. One of the biggest challenges and also people's apprehension is, oh, I don't think I can buy a house because of my credit. So one of the first things we do is we do what's called a soft pull. A soft pull is something you normally don't see, but that's something as a lender I have access to. I call it a little sneak peek into your credit. So this is something my team and I always do. So I don't care if Credit Karma tells you your score is 800 or, Facebook group told you whatever. We're going to soft pull everybody because you'll be surprised. There's different types of credit scores. We'll do another session talking a little bit about the different types of credit scores. But the major two are Fico scores and Vantage scores. Fico scores are what lenders like myself, car dealerships, anything with finances, we use something called a Fico score. Your Credit Karmas, some of the Identity IQ, Privacy Guard, things like that, they use something called a Vantage score. They're totally two different algorithms. It's kind of like buying a Mercedes and buying a BMW. They're both nice cars, but they're just really different. So what we focus on is Fico scores. Another important part of Fico scores there's about 10 different models. Mortgages, we're still doing 1980 models, but we use something called FICO 245. And if you kind of keep up with credit or think you're credit savvy, they just released a few months ago FICO 10. So if you have anyone that has a Zelle account, like your Chase accounts, Navy Federal, even like Discover cards, credit cards, it might be a FICO score, but it might be like FICO 9 or 10. So those are good guidelines, but they don't use the same FICO score model that we use as lenders. But that was a lot. You don't have to worry about it, but we just like to educate people, because the biggest thing I get is, I know my credit's good. Credit Karma said my score is 60. And I can't tell you, I feel like I'm the Credit Karma dream killer. I'm like, well, let's just go take a look at it. So that's just one thing I want to express to people. Let's say you're really, really apprehensive, and you don't want us to pull it. There is one other option that we give people. It's a very friendly consumer model. It's called myfico.com. Mm-hmm. And that is a consumer friendly website that you can go to anytime, and it gives you all your credit data and it gives you your scores. So that's something that you don't need a lender. I encourage everybody maybe once a year to go on there. I like it better than my annual report. Even though my annual report is free, it gives you content, but it doesn't give you your scores. So when people ask, myself or other lenders, hey, I kind of want to check my credit. I don't want to buy to maybe next year. I don't want to bother you. I don't want you to soft pull it. www.myfico.com is where you need to go.
Got it.
Okay, perfect. I do have a question, because this is the one that we get a lot. So people, you mentioned a soft pull. People are so afraid to get their credit pulled by a lender because they're like, their score is going to drop. And I'm like, well, if it's bad, then what difference does it make? But I was like, okay. So can you kind of give people just some guidance about like how much, if their, credit will drop, their score drop a little, drop it all, or if it drops, like kind of like how much, it typically may or may not drop, depending on if it's a soft pull, hard pull, that sort of thing.
I agree. I think some of that's a myth, but like you said, this is what this call is about education. So let me add, that was a few different questions. So let me try to answer them the best way possible. So the cool thing is, with a soft pull, which is what we do, it does not affect your score.
That's great.
Only hard pulls affect your score. So that's one reason I said, I don't care what you say, we start everybody with a soft pull. That way we can do that sneak peek and to see like what we're looking at. If you're ready, you're ready. Then we will go to the hard pull, which is the next step. If you're not quite ready and we need to do a more personalized blueprint, we will. As far as, but at some point, it doesn't matter if you're buying a house, car, anything financial, getting a credit card, they're going to have to hard pull your credit. The good news is hard pulls are only on your credit report for 2 years. And usually anything under 4 hard pulls in a year is not bad. Anything more than that, that's when it can start lowering your score. So 1 to 4, not so bad. They used to have this thing back in the day. I'm showing my age now, where you would go buy a car and they would run you through 22 different auto finance companies. Well, that would drop your score a lot. So people, some of us a little bit more mature customers, remember those days. Like, I don't want to pull it because I remember when I bought a car and my score dropped 60 points. So they did notice something like that was a problem. So probably about 4 or 5 years ago, they changed the algorithms. So if you're buying a house or a car in the same industry and they pull your credit, if as long as it's within the same 45 days, it only counts as 1 pull. So let's say, even though I'm your guys' preferred lender, let's say they went to Navy Federal, they went to Chase, they went to me, a couple other companies. As long as we all hard pulled it within that same 45 days, it's only going to count. The algorithm's only going to read it as 1 credit pull.
And that's something that we do share with our clients, because we're like, they want you to, be a educated, shows that you're a, educated consumer. Like you're shopping around, you're trying to find the best deal. So, okay, that's good to know. Okay.
I think that one of the other things that I did want to talk a little bit about as well is obviously COVID-19 has impacted a lot of different people in a lot of different ways. And so we have a lot of people who have asked us, especially those who are self-employed. So that's a whole nother question that we could put another day.
Yeah.
But especially those who are self-employed are always asking us, okay, so COVID-19, with COVID-19, are there any different rules or regulations? Are there changes that I should be aware of? And is it something where, like, especially for a self-employed person, am I being asked to add more information or give you more information? Because obviously with COVID-19, a lot of people had a period of time where their business may have dropped.
That is an excellent question. So I would like to address that for both regular W-2 employees and self-employed borrowers as well. With W-2 employees, they just want to make sure what they do is now up front, we do what's called a verification of employment. So, and they always did it, but now they do it 3 different times. Prior to COVID-19, they might check it once. Now they check it 3 times. So when the application comes in, we verify the employment. Towards maybe 3/4 of the process, the lender will either do a verbal verification or a written verification. And then the day before closing, they're going to check it one more time. True story, a few months ago, had an excellent borrower, had 800 credit, was getting closed in about 14 days. And then literally 3 days before we were closed, I see the look on, you see it coming. He said, I don't know what to do. They just told us they're permanently laying us off. And, employers can't lie about that. That's like a federal crime. So it was clear to close and everything. 3 days before closing, we couldn't close because, they were going to permanently. Yeah. So with W-2 employees, it doesn't really change, but just let you know they're going to change it 3 times. So don't quit your job, don't change your job. And he had to disclose it because they were going to find out.
Of course.
Yeah. So luckily he had a family member that could co-sign for him.
Oh.
So we closed about a week and a half later. Not everyone's
involved in the story.
Oh my gosh, what a roller coaster that story was.
Yeah, it was. Yeah, welcome to the world of lending.
Exactly.
Right.
So, all right. So I probably didn't mention this to you guys, but one of my niches is self-employed borrowers. We started specializing in self-employed borrowers probably about 10 years ago. My mom was self-employed. I was out of town. I live here in Georgia. My family's from the Midwest. And just what her loan officer was telling her, I said, that sounds crazy. Like, that can't be. So guess who started researching self-employed loans? 10 years later, I'm a guru. So that's just like one of my special hearts, because that's really another big myth that I get all the time. Oh, I'm self-employed. I don't think I can get a house or whatever. Yes, you can. Sometimes it can be a little bit more challenging, but if you come to me, the sooner you come to me, the better. So I'll go over really quickly how it normally works, and then I'll tell you how it's a little bit different with COVID. So with self-employed borrowers, we have a couple different options. We have several programs, but I'll just go over the top 2 or 3. The top one is your real tax returns, just like a W-2 employee. As long as you didn't write off everything on your Schedule C, that's something I'll look at with you. We'll go over your taxes together. But I find at least 60% of the borrowers that are self-employed file pretty good taxes. And they can just use their regular tax returns. It's nothing you're doing different. Another myth that people didn't know is, okay, I pay myself, or I have K1s. K1s are those people that have S corps or corporations. We can use K1s as well. So if you don't pay yourself anything, but the business can show the money, we can use that as well.
That's awesome.
That's awesome.
And those are still 3 to 3.5% down programs. So that's just, yes. So that's definitely one thing I want to share with self-employed borrowers. Now, if you're like my mama and you write everything off, you got to go what's called a non-traditional program, which is something like bank statements. So as long as you can show the deposits coming in on a monthly basis, we can use that as your income. Probably the other 40% of my borrowers do like some type of bank statement program.
Is the down payment? It's not 3%, right, for bank statement?
No. Look at you. I'll make you a loan officer before this time. When we go over everyone's blueprint, the different options, we look at everything I just said. But the one thing is, and we try not to go that route, but sometimes we have to. If you go with an alternative document program, the non-qualified programs like bank statements, the minimum down payment is 10%.
Okay.
We do everything in our power to try to get you to a traditional program, but sometimes it just is what it is.
Right.
The cool thing is a lot of those borrowers that write off, 100, 200,000, they have, the 20, 30,000 to put down. So it kind of to me works out pretty good. If I know in the next year or so, some of the self-employed borrowers came to me in June. I said, hey, I saw you wrote off a lot of stuff last year, especially people right now, right before you file your taxes. I was like, hey, if you're self-employed, please let us, my team. I have 2 certified tax preparers on our team. Let one of us look at your tax returns before you file them. Again, this is for self-employed borrowers. W-2, your stuff is pretty straightforward. Right. If you're self-employed, or if you're W-2 and you're not sure about some things, before you file them, and you're going to buy a house with us in the next year, let us look at it. Too many deductions can kill your deal.
Right.
And what the bank does is they take a 2-year average. So if you show that, let's say you want a $200,000 house and you have to show that you make $5,000 a month. Well, if you wrote off everything and showed that you only made $10,000 last year, you're going to have to, show enough this year to average both the years. And that's something we go over with the clients one-on-one in detail, to make sure that their income does make sense for the house they're trying to afford.
Yeah.
A question came in from one of our viewers. Thank you, Tanisha. She said, is your lending exclusive to Georgia? Do you cover California, or what other states can you lend in?
Asking for a friend, Tanisha.
Thank you. That is an excellent question as well. We are licensed in 15, 16 states. 16. We just added Kentucky.
Yeah.
I'm probably going to forget a few, but just off the top of my head, we have Georgia, Florida, Tennessee, South Carolina, North Carolina, California,
Yay.
Maryland, Florida, Louisiana, Georgia, Michigan, and I'm probably missing a couple. But it's definitely on our website. So yes, we cover, I'm mostly friendly on the East Coast and the South, and then, in Arizona. And then we do a few West Coast states as well.
Okay, so I just put your website up here. Put your website there. So if you want to, apply for a loan or find out more information, contact Dianna at mortgageblueprint.com. So there you go.
Yes.
I did have another question. So I was talking with a realtor friend. I haven't had this issue, but talking with a realtor friend, and she was saying that her client's deal, the lender wouldn't approve it because during, I guess, the beginning of COVID, there was a gap in her client's employment. They kind of got laid off temporarily and, got another job and, had that income for a while. And so what happens in those instances? Like, can you overcome that, or what should someone do if they're, laid off for a period of time due to, COVID? There's a gap in their employment.
Okay. That's also a good question. These are some good questions tonight.
We try.
Yes. Gap in insurance would happen all the time. It's just not a COVID thing. It's more prevalent now, but we've always been dealing with issues like that. So how the lender looks at it is, hey, we understand life happens, so the only requirement is they want to see 30 days of history that you work it again. So like the other day we had a teacher She was laid off kind of for COVID, but she just went back. And she just went back. So once she can show us 2 paycheck stubs, 30 days worth of income, you just have to write something called a letter of explanation, saying something like, in this case, due to COVID-19, I was laid off in May. Now I'm back working full time with Fulton County Schools. And then we just show the 2 paycheck stubs because she's had a history. She's been working there for 8 years. So it just makes sense.
So I know people are going to ask, if they get paid monthly, does that mean they have to wait 2 months?
Yes.
Oh God.
Y'all are smart. Yes. So phrase that better. You are correct. I need to see 2 paycheck cycles. Okay. So if you get paid monthly, I need to see, well, let me rephrase that. I need a minimum of 30 days, or if you get paid 30 days, I need 2 paycheck cycles. Because if you get paid weekly, technically that's 2 weeks, but they still want to see at least 30 days worth. Okay. So 30 days, or if you get paid once a month, we need to see 2 paycheck cycles.
Okay. Got you. So we have some questions. I know you have some formal information that you want to share.
Yes, this will make sure we answer all the questions. So again, I want to go over a few things because again, the biggest question I know I get as a lender is the credit. People don't care about buying a house or nothing. Which is good. I think it's really important because I tell people we're not just getting you into a house. The blueprint is bigger than you just getting a house. We almost want to call it a financial literacy program. That's why we have a credit side, we have a tax side, because we want to be your one-stop shop for everything financial. You trust us. We're going to get you from the start to finish. Another thing we've implemented at the end of 2020 is we do what's called a post-closing class now. A lot of times after, I know, right? A lot of times after you get a loan, you probably never talk to your realtor or loan officers that much anymore. But to me, that's just the beginning. There's so many questions, and should I do homestead taxes, and how do I write off my mortgage interest? There's probably so many things after you buy the house that no one, you don't know where to turn to. So we started at the end of last year, and we definitely going forward in 2021, we're going to start offering the monthly post-closing classes just to cover anything that happened after you close. Definitely we'll have, definitely we're going to do, a couple together because like you said, there's, like I said, a lot of questions for the realtor after the closing as well.
Yeah, and our clients don't hesitate to reach back out to us.
Well, I think sometimes, like you said, they get scared. So like you said, just we're doing a webinar. We're just going to start doing a couple of these, just a post-closing webinar. Everybody can join. We'll cover the things that we think are most important. And then, like you said, people can just jump in because a lot of times they have the same questions.
Yeah.
I don't want this call to go too long, but I did just want to go over a few things about credit. And these are credit tips that not just buying a house, but for everyday things. So like you said, you want to go to Rooms to Go and get a credit card or a car. These are credit tips that we share with all our clients. Just not to only get them mortgage ready, but to get them life ready. Right. So I'm going to share my screen.
Okay, well, we're going to get out of here.
All right. I appreciate everyone's patience. All right. Can you guys, somebody taught me how to do, there we go. You know what? Let me make sure I did it right. There we go. All right. Can you guys see my screen? Hello?
It's not showing up.
You said it is?
It is not.
Okay. Uh-oh. Let's see. Can you guys still not see it? Man, we practiced this. All right, hold on. Okay, give me 1 second. We're gonna try it one more time.
No problem.
I am in the slideshow, so I'm trying to.
Did you press the share screen at the bottom?
I thought I did.
Try it again, maybe.
Okay, hold on. It's making me get to the end. Hold on 1 second. Okay, let's see. Share.
There we go.
All right. Thank you, everyone. Please do not let my technical my technical prowess stop you from getting a mortgage loan with us. All right, awesome. All right, so yes. So again, the major part of this call today is we want to just kind of briefly touch upon credit. And I would be happy to share this slide or this slideshow with anyone. Some of this, a lot of you know, and some it's just basic information I think everybody should know. So basically what I'm going to talk about is just how to improve your credit score. The biggest thing is knowing how, what type of things affect your score. So we already touched upon a couple things like, hey, how much do inquiries, count and things like that. So to me, there's 5 major factors that determine your credit score. And another important question I get sometimes is, well, how do I know what a good score is? Well, the lowest score is a 350, and the highest score is a 850. In mortgage terms, as long as your score is 640 or above, that's considered a decent score in the mortgage world. So the biggest category that I think is the most important and the thing that you can manage the most by yourself is 35% of your score is impacted by on-time payments. Anyone that's ever had a one-time late payment will see instantly your score will drop 30, 40, 60, 80 points. So the number one thing you can do is to make sure you pay your bills and your revolving credit on time. Now, on time means not 30 days late. So let's say your bill is due on the 17th. If you pay it on the 19th, you're still okay. If your bill is due on the 17th and you wait a whole nother month and pay it on the 18th and it's 31 days late, now it's considered late. So that's the biggest impact that I can share with people is to just keep on-time payments. Another little nugget is underwriters look for on-time payments for at least 12 months. 24 months is better. So the reason being is if you have a $20 Discover card and you can't pay that for the last 3 months, how are they going to give you, a house, with a $2,000 payment and you can't pay, a $20 payment? So that's kind of how the underwriter thinks. Another important factor of your credit is we call it utilization, but it's how much the balance that you owe compared to what you have. So you could have wonderful on-time payments, but if you have like a $300 credit card and it's always maxed out at $299, your utilization is like 99%. That's not good. Most lenders, most banks want your utilization, your balance to what you owe, to be under 30%. 10, if you really can do it, under 10%, but 30 is like the target. So in that same scenario, if you have a $300 credit card, you want to try to keep the payment, the maximum balance, I should say the maximum balance under $90. Those were the 2 major factors. Another factor, it's not as big, but when you're adding up an algorithm, you're adding up points, every point matters. So another important factor is how old your accounts are. If you just opened up 5 new accounts, they're not going to give you as much point value as if you've had like older people. That's why older people traditionally have better credit, because they've showed that like my mom, same example. She's had like, I didn't even know Sears was still open for like 50 years. So, she's getting like all the extra algorithm points for that. If she were to go open up something tomorrow, she wouldn't really have that same credit history effect because it's not the history is not there. So another important part is when you're opening up credit is if you open it, even if you change your mind, like we all think, oh, let me go get that, Zales card, that Walmart card. Even if you decide to close it you have to keep it open for 6 months. Closing new accounts actually can really hurt your score. So definitely, you want to keep accounts as long as you can, but definitely at least 6 months. This is something we touched upon earlier. How does it affect you if you're shopping for mortgages or shopping for anything? That counts about 10% of your score. So even if for some reason you had a bunch of credit pulls, it doesn't hurt you as much, but you just want to watch that because again, every little bit helps when you're trying to achieve the best score. Another small item, but it's something that we actually as mortgage lenders really look at is the types of credit you have. They always want to see at least 3 to 5 different accounts open. And when I mean accounts, they want different accounts. So maybe a student loan, maybe a house, maybe a car payment, a couple credit cards. They like to see a good mix. If you have 10 accounts, they're all student loans, you'll probably never achieve, a high 600 or 700 score because there's no mixture. So you definitely want to make sure you have a little bit of mixture of everything, car payments, credit cards. So then you'll get the maximum point value in that category. And that's kind of all I wanted to talk about the credit. We definitely can always do another webinar or something if we want to talk more about credit. But another major thing that clients ask, I'm sure they ask you guys and they ask me, is about 100% financing.
Yes.
So, which to me kind of deals with credit. I know maybe from the outside looking in, you guys are thinking, but to me it does. So once we get your credit up and we get you to at least a 620 score, I feel like it's just free money out there. If you can keep your own money, why not? So here with Nexa Mortgage, we offer 12 different down payment assistance programs. Again, I'm not going to spend too much time on this, but the minimum score is a 620. If you do not have a 620 score, no worries. The Mortgage Blueprint has you. We'll go ahead and, do a one-on-one session and we will help you achieve that 620 score. Most of the programs now, especially since due to COVID-19, are FHA friendly. Not too many conventional down payment assistance programs. But again, if you need that extra assistance, here in Atlanta, it's in states like California, Maryland, Florida, and Georgia. Right now, it's called a seller's market. And I definitely, I got one more slide after this. I definitely want you guys to talk about that and how it affects the closing costs, because we get that a lot on our side. But right now, being that it's a seller's market, realtors aren't getting that much closing cost. So you could have been really smart and saved up for your down payment, but you're still short of funds because of the market. So don't think down payment is always for poor and needy people. Like with the market right now, we're doing more than ever of these type of programs because, you might save up 10, 15,000, but you might need another 10,000 for closing costs. And that's just a lot of money for anyone to come up with. So we offer 12 different programs, and it's basically getting you in the house with as little money as possible.
And I think one of the important things that we should probably point out too is a lot of people will say, well, I'm right up kind of on the cusp, and what's the big deal? I'll just go with, if I'm at a, 630 or 635, I don't know, instead of a 640, even something close like that. Can you kind of give people an idea? Because we deal with this a lot where we say, I think it does make a difference for you.
Can you ask me you said, what was the difference?
Sure. If people are kind of on the cusp, if they're really close to the next category of credit score, how much of a difference could that really make for them?
It makes a huge difference. We call it credit buckets. So the buckets go every 10 to 20, depending on points per lender. So there's like a 600 to 620 bucket. There's a 621 to 639 bucket. And the easiest way to explain that is the higher your credit score, the lower your rate. So the other day, I had someone that had an 800 credit score. Their rate was 1.99. The same type of rates at 1.99. That same type of loan, I had a borrower with a 640 score. Their rate was 2.99. Now, hey,
that's still good.
It's still good, but it's now 1.99. So that's why I said it does make it. In the bigger house you buy, the bigger difference it makes. If you're buying $100,000 house, maybe not so much. $500,000 house, 1% difference over 30 years is thousands of dollars.
Major.
So if we're close to a bucket, I have a wonderful, wonderful credit specialist on my team, Monique Brown. Give shout out to Monique. And she looks at things like that. So if they're close to a bucket, she has fancy tools and analyzers that we do for free that will get you if we think we're close. Because like you said, we're all about educating and helping people and getting them in the best program in-house possible.
We love that because we have so many people who are almost right there, the next category, next bucket. And we just tell them, you're almost there. This is something that you can rectify a lot of the times.
And usually it's something easy, like that utilization we talked about, the balance. 9 times out of 10, that's something. And we have something called a rapid rescore. We can update that in 3 days. So that's one of the first things we look at. Our little analyzer system tells us, hey, if they pay down this card by this, they'll get the score that we need. And again, those are the type of services we offer for free to everyone.
And that's what we, kind of direct, potential clients with. We're like, you need to talk to the lender. Like, they want to go to credit repair, they want to do this. We're like, okay, lenders are the actual people lending the money to purchase the home. Don't you want to know what they want to see? Talk to them. I was like, a lot of them will analyze your situation free of charge, just like a part of their service, and hopefully you using them in the future. So yeah, like what do you have to lose? So yeah, that's great that you were able to kind of clarify that, because it just kind of dittos some of the stuff that we already tell people all the time.
I kind of mentioned it a couple slides ago, but can you guys tell them, so it's not me always giving the bearer bad news, how like current market situations are, especially about like the closing cost and what kind of market it is, because I get that on my end all the time. They're like, oh really? So
yes, so especially in the city, pipe in whenever. We are in an extreme seller's market in the greater Atlanta area. I pulled some stats for just like all the major counties, like the 6 major counties, in the greater Atlanta area. And most of them had 0 to 1 month of inventory. So that just lets you know, like, there's just nothing out there. Also, we've had a couple of listings recently where, we received over like 30, 40 offers, above asking. People are there's just no inventory out there. So when a seller, sees, 30 deals, some of them cash or just above list price, like you can't really ask for anything. Your offer isn't competitive in this market because there's just so few homes available. So, when we have buyers, we know like if it's a very popular kind of area, or if it's kind of like in this great like price range, like under 200,000, we know like it's going to be super competitive. We do counsel them. We're like, hey, if you want this home, you want this property, there are just things that we, sellers pay closing costs. Those are going to be the first thing that's off the table in a lot of these negotiations. So
it's just the climate that we are currently in. And I think it's really important to understand that this is not you should not take this and say, well, I don't have any chance. And this is exactly why down payment assistance programs that you're talking about are so incredibly important to people. Because with that down payment assistance program, that's one less thing that you're going to be paying for. That's one thing you're taking out of your bucket. So you can then say, okay, well, I do now have that amount of money that I was saving for my down payment assistance, and I can put that towards our closing costs. And that makes you a very competitive buyer in this particular market. There are always things that we can try to do. I mean, we can't change the market or change the fact that it's a seller's market, but that's time when you as a buyer begin to expand your horizons a little, and you begin to rely on your realtor in order to really find the right home for you. But it may be that it's not exactly the home that you had thought in your head, but we can really put you onto homes that may be something that you weren't even thinking of. And so we need to just be very strategic when it comes to closing costs. And again, if that's one thing that we can take off the table and we're not going to have to ask the seller, that is going to be so much better, and it's going to make us so much more competitive.
And that's a part of, like, I think it goes to like just the consultation with your lender. Like you said, you've had to kind of counsel people, and that's like a part of what we do as well. Like we have very intimate knowledge with what's going on in the market, and we're able to just kind of counsel you and kind of guide you. I know Nasia had a client where, like you were saying, like some people have, like, they save for the down payment, but they're like, oh, closing costs? Like, are you serious? Like, I don't have that. So that's why, us kind of knowing about or partnering with lenders and knowing what their programs are, that's how we're able to, like, find the best fit for our clients and kind of help them realize their goals. So we're like, yeah, yes, this lender has 100% financing program. You don't have to now worry about the down payments. Now you can, like, kind of put that all, like Nasia said, towards your closing costs. So it's kind of like, just being that consultant, us just knowing what's going on in the market, staying abreast of that, and having, like, great partners that we know, like, if we have a certain client, we're like, okay, this is a good fit for this person. They have that program. Or, oh, you want to be in the cab? Like, oh yeah, there's that program. Like, let's do this. So yeah, that's just, like, all a part. And that's why, like, people, there's so much information out there and everyone has access, but it's so important to kind of consult with professionals, because this is what we do every day.
Right. And we will be very frank and tell you that even if it's a buyer's market, no seller actually is, there's no compulsory regulation or rule that they do have to contribute towards your closing costs. So even in a buyer's market, it's still something that's up to negotiation. While it's more prevalent in buyer's markets than it is in sellers markets, we do have to kind of counsel people that when you go in to this process, nobody owes anybody any money or is promised any money.
That is true.
Yeah. But on a really happy note, because we don't want people to think
Debbie Downers.
Right. So we do love the fact that you have 12 down payment assistance programs, because that is a lot. So I feel as if for somebody who may not, in one program may not be right for them, another one is. So when you have those kind of options, and especially if the higher you grow with your credit score, and of course, like, depending on your income and all those qualifications that you take into account, it really is so great to see that there's just a plethora and an array of options.
Yes. Okay.
Kristen, did you have any other questions?
I did. Okay, this is one we come up with a lot, and I think some people have figured it out, but just kind of want to get your opinion. So if I have good credit and a lower income than my spouse, how can we navigate the so you have like the spouses where one has the credit, one has the money. How do you all kind of like navigate and advise on that?
We put and again, looking at all the factors, we put the spouse, the person with the lower credit, we put them in the credit blueprint, which is our sister program to the mortgage blueprint. It's called the credit blueprint. Makes sense, right?
Yes.
It depends on what type of program they want. Again, even though we do loans down to 500, try not
what's the interest rate on a 500 credit score loan?
Yeah, but sometimes it makes sense, but
sometimes, yeah.
We try to get everybody to at least a 580 or above. So depending on where that spouse is, we try to get them as close as we can, as quickly as possible to the other spouse's score.
Okay, that makes a lot of sense.
Because most time, people want a bigger house, and they're going to need both incomes.
That's the challenge. They want both incomes, but only one person has good credit. I was like, that ain't gonna work.
We put you in the credit blueprint. When you're ready, you come back over to the mortgage blueprint. Bada bing, bada boom. Get you in the house.
See, solutions. This is what I like. This is what we love about our partners. Where others see obstacles, I see solutions.
It's not a no, it's just a not right now.
Right. Exactly.
Right. Like that's what we tell people. Like it's never a no. It's just not right now. Like that's life. So I do follow up. So you mentioned the credit blueprint. Is there a cost associated with that program?
Yes. We just do a flat $99 month to month. There's no contracts. There's no upfront fees. Again, we're not trying to get rich off of. We're not a credit repair company.
Now, that's fairly fairly reasonable.
We do those things up front. Now, before we charge anyone or we do that, we try to do the free analysis. They get to me. We do the different little tools and things. But sometimes truly people need a little bit more help than we can give them internally. So again, we send them over to our sister program with a couple of our affiliates, the credit blueprint. And that's all they do all day long. Those are credit specialists, and they get them ready and they come back to us.
Got it.
Awesome. So I think like we're good. Is there anything else like you want to share? Like parting words? Like I said, I'll scroll your information again.
The only thing is we are doing a January, February special. Guys love those specials.
Yes.
Anyone that reaches out to us and partners with us, because this call is about getting with the right partners. We are doing a $500 lender credit at closing.
I love it.
That usually covers the whole appraisal.
Right.
Some people home inspections, sometimes that'll cover the radon and the home inspection. However you want to spend it. We will be doing $500 minimum. We'll have other contests throughout. I know MLK, you might want to check out our website. There might be some specials on the website. In honor of our Martin Luther King Day, our king here in Atlanta, Georgia. So always, check out our website. We're always having different specials. And anytime a new program comes out, new program came out this week. We'll have a separate webinar about this. I would love you guys to join. I'll end it here. It's verification of employment only. We'll leave it there.
Self-employed people.
I just want to shout out Monique has come on. So she's like Credit Blueprint Pro. So hey, Monique.
But we'll leave it there. Different programs all the time. The last thing I'd like to say is if you're not sure, please call one of us. We're just a call, or me, I'm just an email away. You never know what you will qualify for, or what you can do if you don't take that first step.
Yeah.
Agreed.
That's it. So once again, like very informative. Thank you for joining us again. Like always, great information. Again, reach out. And we'll have our information. You can reach out to us on Facebook, hit our DMs, comment on
Yes,
this
be sure
video
to follow
anytime.
as well. So whenever we're doing something, you'll be the first to know.
Yes, subscribe to our YouTube channel. Thank you so much again for joining us, Dianna. It's always, like I said, always a pleasure. So awesome. Thank you,
Have a great
guys.
night.
Thank you. Bye.